Welcome. My name is Frank Aibogun. I am the publisher of Business Day. What a delight to welcome all of you to this very interesting conversation. I particularly would like to welcome our panelists, our moderators, who have kindly given up their time to speak with us or to speak to us for the next 2.5 hours or so. We have a very impressive array of panelists and speakers this morning for this conversation. And as I said earlier, the lockdown has, or the pandemic as it were, has opened our eyes to newer ways of doing things. And we are now able to hold meetings without necessarily having to go around the city or go between cities if we could. But most importantly, we're also seeing a lot happening, whether in terms of financial flows, in terms of merchandising, happening online. And we know that all of that or is underlined by the quality of consumer finance, the quality of the infrastructure that is available, the quality of credit checks that can be done promptly, and all of that. But I am not a speaker this morning. I'm only here to welcome you. And I think suffice it to say that I believe that with the quality of speakers that we have, that if you have logged into this call, surely you are on to a very exciting next 2.5 hours. Once again, let me thank all of you, especially our sponsors that have kindly offered to support us this morning. Credit Bureau Limited, Credit Registry, Lexigo Microfinance Bank, and of course, Sparkle. I think at this point, let me now hand over to our moderator this morning, Oluwatobi. Welcome and thank you very much.
Hi, good morning. Welcome to the Business Day Fireside Chat. To Uzoma Dozie, the chairman and founders, CEO, the CEO, founder, Sparkle, Nigeria, a financial technology community and ecosystem. Is a banker, is the former group managing director of Diamond Bank, a fintech advocate, and a man who is passionate about women empowerment. Welcome to the Fireside Chat, Uzoma.
Thank you, Oluwatobi. Thanks for having me on.
Okay, I'm sure a lot of us are interested. We're all waiting to know. I particularly am. What is the driving force behind what you do and who you are?
Thank you very much. Well, I think my, one of my passions, it's simplicity. My passion is to help people and also to make a difference in, to play a role in making a difference in the growth of Nigeria. And I think in the last 20 years, we've always, either whatever platform I've worked in, we've always tried to develop new markets where people have not gone. I know that Diamond Bank started as a bank that was providing services to the middle market where there wasn't any before. And when I took over as MD of Diamond Bank, our passion was definitely retail because we believed they were underserved, and there was a lot of financial exclusion, and also not much services or attention to women and women businesses. And we thought that was where the big opportunity was. And we knew that using a retail strategy would drive that. And I think that, and knowing that the success of any nation is based on the strength of its small businesses and individuals. I think for us, where the opportunity, where the future growth was in retail, was in the mass market. We had seen companies who have come in like MTN and developed a successful business based on providing services to that market. And I believe that can be the same in banking, in agriculture, and in other industries. I think what is required was what medium can we use to provide these services in a cost-effective manner? In fact, in some way, democratize it. And it's technology. So I am not, as people say, I don't love technology. I just believe that technology is a platform, a tool in which we can provide cost-effective services, scale businesses, and create great customer experience. And there's nothing as fulfilling as, providing a service and seeing how what you're doing is transforming people's lives. I think it's one of the most rewarding things that you can achieve. It's a motivating factor. And I think that's, in essence, what drives me. I wake up in the morning and you're thinking, how many lives can you transform today? How can you change people? And how can you give back? Because it's in giving back that you know that you actually make much more.
Yeah, talking about affecting people's lives, I'd like to make a quote to you. I'm sure you are familiar with this quote. To expand the economic assets, participation, and power of low-income women and their households by helping them access financial services, knowledge, and markets. This is the mission statement from the Women's World Banking Organization, which you are on its board. I agree. I think that we share the same ideology, as I also run an NGO called Emmanuel's Table. And so the question to you this morning is, how do you see this organization and or its mission impacting women in this bracket in Nigeria?
Thank you very much for the question. I was on the board of Women's World Banking, and I'm no longer on the board, but we still play a role. So Sparkle, Sparkle is a member of the Women's World Banking Network, and I think the Women's World Banking have played a big role in Diamond Bank in terms of the solutions we brought to the market. With respect to taking banking to the marketplace, to market women, and also developing solutions for small businesses to access credit and in a cost-effective manner. That organization, like organizations like Women's World Banking and much more out there, play a significant role in, first of all, creating awareness of what women do and their role in the market. Now, considering that 50% of the population is women, and women play a key role in terms of development of the home, it's important that they also play a role in education, and in commerce in Nigeria. And so what Women's World Banking are trying to do, and organizations such as them, is to provide and build infrastructure that would help women play their role and create a level playing field that is actually required. Because in any society, you cannot have a successful society if half of the population, as such in Nigeria, is idle, is worked and are working, but are not being paid for. So, like, if you take a woman that has a job, she has two jobs. Looks after the household, which is an unpaid job, and then she goes to work, which is a paid job. So the working hours are almost the same, but in terms of income, it is not fairly distributed. And so that's what one of the areas women's world banking are trying to do. They're trying to, first of all, bring more women, financially include more women by making sure that society identifies them and then ensure that they don't fall into that low income bracket.
Yeah, I agree with you. From the world, it's clear that when power has either directly or indirectly, so we need to empower them, to contribute to the economy. So I totally agree with you. My other question would be, how do you think we can achieve financial inclusion leveraging credit?
Very interesting question. I think, well, in summary, I mean, it has to be digital. But if we break it down, I mean, to achieve financial inclusion through credit, one, we must create a platform that is scalable. Scalable, when I say scalable, it's accessible to many people, so it's easy to request. There's awareness, it's easy to request. It is cost effective, and it is it's cost effective, and it is data driven. Data driven because with so many people out there, it is impossible. We don't have even that human capacity to process credits the way we process credit for large corporates or high net worth individuals. It has to be data driven in terms of I request for credit, I request for a loan on my platform, wherever I am. It is processed, and within minutes or a day, you get a yes or no. And to do that, you have to have a mobile. We have to use existing infrastructure that we have today. And the existing infrastructure that we have, that most people have in Nigeria, is a mobile phone. So to do that, we must first of all build a system that allows people to access credit. A decision is based on the ability and willingness to pay, which today the existing metrics have to be looked at. So today, if I wanted to borrow money, I would have to go into a bank. They'll ask for my statements. They look at my statement, and then based on that, it will be a yes or no. Now, not many people have those resources available. So for us to provide financial inclusion, we need to look at the existing infrastructure, the existing way that people live their lives, and now build the system around them. And it's similar to what banks did in the past. Before, 25 years ago, for you to open a bank account, you had to actually go into a bank. And 20 years later, I mean, people don't walk into banks anymore. People expect banks to open, to come to them, to provide services to them. I'm not sure if you're hearing me. I'm not sure if the network is stable.
I can hear you. I mean, if you could increase the volume, it'd be good.
It must be the rain, because I think we're the loudest volume at the moment.
Okay.
Hello?
Yeah, please go ahead.
Yeah. So I didn't hear the next question. Was there a next question?
No, I was waiting for you to round up on the last one.
Yeah, I had run.
But if you're done?
Yes.
Okay, that's good. So my next question would be, how do you think we can build trust between consumers and the financial systems to increase information asymmetry? As you know, a lot of the unincluded have some trust issues, and we found that that has been a deterrent to those in the informal sector coming into the banking, coming into the banking net. So the question is, how do you think we can build better trust between ourselves and the banking public in Nigeria?
I think trust, I know that trust is based on information. I trust people when I believe that what they're telling me is true, they're transparent, and it's actually quite, and it's simple to understand. If I remember back a a few years ago when many people got burned by derivatives, and that was because, first of all, people didn't understand what they were buying, and most people didn't even understand what they were selling to people. Those kinds of things built distrust between consumer and financial institutions. And on the flip side as well, banks and also financial institutions have been burnt by people who have provided wrong information in which they took financial decisions. So the issue here is, as a financial institution, I want to believe that the information that I'm using to take a decision is correct. And as an individual, when I am accessing financial credits from a bank or a financial institution, I want to believe that they are being very transparent in terms of the terms and conditions of the loan. I understand what I'm borrowing. I understand the tenor. I also understand in simple form the what I'm going to have to pay back. And so to do that, and that is why I'm an advocate for, one, removing bias in decision making and letting data speak for itself. So let us begin to take data-driven decisions. And a simple example is, a man walks into a bank and he's wearing slippers and a t-shirt, and he comes and asks for credit. Of course, quite a lot of people will be very hesitant to actually listen to them or listen to their loan request, and they'll be more fixated on the appearance of the person and take decision based on that. But in actual fact, you'd have to actually look at the customer's data to take that decision. And the reverse is the case. You see people that dress well, that speak well, that people vouch for them, and you take positive credit decisions based on look and appearance. But if you look at the customer's data, you would find that you wouldn't lend this person even 100 naira. So I think to do that, I think we need one, to take decisions based on data, to take decisions based on wider data, not just financial data, which is ability to pay, but also non-financial data, which gives you an indication of customers' willingness to pay.
Thank you, Uzoma. The other question is, how do you think we can use technology to scale the credit market? I know you've alluded to this question in your other responses, but in specific terms, in terms of credit ratings, scoring, in terms of KYC, in terms of decisioning, a lot of customers, particularly the unincluded, who would need the credit, are not able to come in because of what you spoke to. You need a statement, for example. But if I don't have a statement, but I have a thriving business, how can you use technology to do that in a wider scale?
That's a very, very interesting question. And that's one of the reasons why we're excited about Sparkle, because in Sparkle, we're using data to take decisions. Now, if you look at there are two reasons we lend based on two reasons, willingness to pay and ability to pay. Ability to pay is based on your financial ability. Can you borrow and can you pay me back, and can I see your cash flow? Secondly, willingness to pay. If things go wrong, will you make effort to pay? Just like the situation that we find ourselves with COVID-19 today, where businesses have gone down, people can't pay back. They don't have the financial ability, but they are willing to pay if things don't run and willing to sit down to talk to people. But then again, when you look at most people don't have statements, as you said, right? But most people meet their obligations every day. If you take a man, he sends his children to school, that's an obligation that requires finance. And he looks after his home, he looks after his community. So that is a man fulfilling his obligation. How can you now bring that information into a decision-making tool and not just statement? And that's where technology can help you. And you can do it simply by just tracking. You can do it simply by monitoring his expenses, which you can see if a man is paying through USSD or paying through making digital payments through his electronic payments through his phone, and you can capture that information. That gives you a better picture, because in actual fact, nobody keeps their bank, nobody keeps all their money in one place. It's hard to find that, especially in Nigeria, and not everybody keeps their financial assets in cash or in a bank. Some people have it in dollars, some people have it in stocks. How do you capture that whole? How do you capture that holistic worth of a man, of a person? And that's where technology helps. And that's where, when we talk about big data, it's being able to build a system that captures all types of information, so you can take better credit decisions. And the more information that you have, the better the decision, and the lower the risk that you're taking. And that means that in actual facts, you can now start bringing interest down at that mass market level.
That's correct, Uzoma. You know, I'm also aware of a market player who makes credit decisions on the back of ATM transactions. He looks at, say, Uzoma, and says, Uzoma withdraws from the ATM every month in the last 6 months, you know, 200K on all the ATMs across the banks, and is able to then extend a 50K credit to Uzoma, because he can see that somehow Uzoma consistently in the last 6 months has withdrawn, you know, 200,000 naira from the ATMs across the network. You know, so you're very correct. It's the way to go. And because, like, you know, the size of the transactions in the informal sector is huge, and it's not being captured today just because there's no history. And, you know, we're not able to bring them in. Thank you so very much for that. Go on.
No, I think, and you're right, because people have history, but you have to build systems. So now today, I think one of the things that fintechs have the capability of is actually building systems around people's activities, so that you don't force them to change their behavior. You can now capture their history and now translate it into their financial capabilities.
Yes, you're correct. It's just following that transaction life, you know, what do they do every day in terms of transactions, and then seeing the bigger picture beyond what is in their accounts. My next question would be, what social structures can we put in place to facilitate better credit and willingness to pay back credit loans? You know, as Nigerians, Nigerians are known, so to speak, not to be very good with handling credit, you know, and not paying back as they should. What's your opinion, and what's your experience as well?
Well, I think, when people say that, you know, when people say that, I wonder, because that's a small data set. You're looking at a small data set of people that are borrowing money from a structured environment. But the unstructured environment is much bigger, and we haven't been capturing data. And so, you know, this question is, you know, just follows from the last discussion that answer that I gave. Is, first of all, we need to, and at Spark, when we build Sparkle, we build Sparkle from the ground up. So we actually didn't buy a banking solution and then customize it for the Nigerian market. We said, okay, how are Nigerians living their life, and how can we build the structure around them so that they continue living their lives, and we capture the necessary information that we need to take information. And that's what we need to do. So one is, you have people who have never borrowed from bank, but they've borrowed from their family, they've paid back, they've borrowed from non-financial institutions, they've paid back, they live their life, they buy DSTV. How do you capture all that information? So and when he wants credit, you shouldn't ask him, go and bring this, go and bring that, go and do this. You know already. You know that this guy has the willingness to pay, and has the financial ability based on how he lives his life. And to do that, you need to start building, you need to start tailoring your information gathering systems around that. Secondly, rule of law is very, very important. If you're going to borrow, if you're going to borrow and not have no intentions of paying back, or you don't have the willingness to pay back, the law should support the lender. And so we need to look at those laws and how we can make it quick and effective, and it's fair. That's the most important thing. And then we also need some changes in legislation. I think, for example, I know that if I want to get a mortgage, the cost of a mortgage is very, very high, because, you know, the cost of documentation, the cost of even transfer of title. And in the UK, where you can do that, you can do 3 transfers in a day. We need to start doing those kind of things from a collateral perspective, so that you know, it's easier to lend. It is, and when it is easier to lend, it is cost effective, and you can actually bring the cost of lending down. One of the big components of interest rates is just that whole infrastructure that you have to put around ensuring that you lend people other people's money and you get it back. If we can remove some of those operational risks from lending, and the only way to do that is digital, then you will see you will want to be able to lend to a large population of people at the corporate rate. So it's just looking at building systems around people, rule of law, and some alignment of legislation to facilitate lending. Toby, you seem to have frozen. You're back.
Sorry, I lost you for a minute there.
Yes.
Okay. So, you know, let's look at data. I mean, since the beginning of this fireside chat, I've seen that you've sort of spoken about data at different times. And I totally agree with you that it is critical. It's what makes the difference between an efficient system and an inefficient system. So let's discuss structured versus unstructured data, how it is gathered and subsequently used, you know, to determine the affordability of credit as well as the lending criteria. What's your experience, and what would you say is it's your opinion of how it should be done?
You know, I like to use like real life examples to to buttress my point. Today, you know, if I want to move from here to Keja, I would just, you know, based on my driver's experience or my driving experience, I would take a route. I'll take a route that, you know, has based on my that I think there will not be any traffic, but I don't know if there's been a traffic jam or a lorry has topped over and caused backlog. Today, I use Google Maps. Google Maps tells me the best route to take. Now, people, sometimes it's wrong, right? Sometimes it is wrong it's wrong because things go wrong. But the probability that it will be wrong is much lower than if I use my own judgment, because they're taking data, they're using data using big data analytics algorithm to determine how long it's going to take you based on certain things. Now, those are things that machines will always be better at. Now, if we can, and that is unstructured data, but allowing you to make structured information. Now, another example is when you interview people, first of all, you get their resume, and the resume tells you, people put in the resumes the best of them, what they want you to see. Then what you do now, you go to their LinkedIn, you also go to their LinkedIn profile, you go to their Facebook, their Instagram, and you see what they are. And now, if you imagine you could take these two, I take your financial statement and I take your unstructured data, and in taking a decision, I now look at that and say yes or no. And that is the combination of taking unstructured and structured data. Now today, unfortunately, the banking systems were not built to do that, to accommodate that. Information is in silos. Now at Sparkle, what we're doing is like we built our platform so that in taking a decision, we're looking at your media, your social, your informal life versus your formal life, what you want people to see and who you really are to take that decision. And I think that is the power of combining these sets of information. And the more information, and to do that, you now need to build a system of sharing and collaboration. We can no longer just competing against each other, using our own data and building expressive instruction. And a typical example is COVID, where you can see the world now, institutions are sharing information to try and get a vaccine to stem the epidemic. Because if we don't work together, then globally, economy, there will be continuous recession, which will not be good for us. So like, this is a time, this is a good example of how sharing and collaboration is better for the greater good, so that individually you can thrive in society. And that's why structured and unstructured data is important in reducing even the cost of lending to people.
Yeah, I totally agree with you. You know, the man is not just what you see on the banking application of a bank. The man is a total man, you know, his social life, his financial life, family life, all of those things make up the person. And when you have that in full information, you would understand, for example, why some organizations would say, we would like to have, you know, a man who is married with children in a particular, you know, role, because they understand that this man has responsibilities. I will not make decisions lightly. You know, all of these things are the kind of information that will help make better decisions as it concerns giving credit to Nigerians. Talking about that, you know, how do you think we can use data to remove human bias from decision making in terms of granting credit? As you and I know, there is data, yes, but at the end of the day, somebody still needs to click the button to say, yes, we will grant or we would pay. And that is where the human bias possibly comes in. So the question is, how do we remove human bias from decision making in the credit market?
Well, I think I just go back to my Google Map story. I mean, like, so I can Google can tell me that Google will tell me that use route A, and I think no, based on my experience, I have that problem sometimes with my driver. He will tell me, "Oga, let us go this way," and I'm telling him use route A. Then we use route B, and then we end up in traffic. And you do it again, and you find that after a while, hey, maybe I better leave the machine, let the machine take the decision. And if it goes wrong, well, it goes wrong. And I think that's the whole thing. I mean, like in the next panel, I mean, like you have experts there who will tell you that you have to price in risk, you know, and so no risk, no return. And that's the whole idea. The whole idea is that things will go wrong, but you price it in. So if I'm lending, so I don't want any human intervention in taking a decision. And so, like, if the data, you build your credit scoring, you build your algorithm, and if the data tells you that this guy is good for it and this guy is good for 100 naira, then you go with that. And then if it is wrong, then you can continue to tweak the algorithm or the credit scoring platform. And I think that's the way to do it. We have to be disciplined and we have to let the machine do its work, because we believe that their decision-making capability based on its gathering of more information than any human and assimilating and processing it will be better than, especially when it comes to very small ticket transactions.
Mm. Okay, this discussion has been quite interesting and insightful. And as a final question, you know, where do you see the impact of Sparkle as an organization on the market and entrepreneurs in the next 5 years? And this is quite particular to looking at the post-COVID and the impact of COVID on the small, you know, SMEs who are struggling, you know, to even stay afloat right now, where we see large organizations letting staff go, cutting salaries, you know. So the question is, where do you see Sparkle impacting this market from now into the next 5 years?
Okay, there's no, I think the whole thing, everybody is saying there's no progress without disruption. And COVID is presenting the biggest disruptive circumstance, which leads to a lot of opportunity, and that is the opportunity for Sparkle. And like I said earlier, Sparkle was built Sparkle is digital. And what you've seen during the last 2 months, especially in Lagos, is one, awareness, higher awareness, appreciation, and adoption of digital. And that's exactly what. So Sparkle is a platform that provides financial, lifestyle, and business support services for individuals and small businesses. And small businesses are the engine of growth of any economy, and not big business or government. And I think sometimes we keep forgetting that. We have about 39 registered small businesses in Nigeria. And I believe if they improve their efficiencies and productivity by adopting digital and if even 30% of them can hire one individual person, you will see an uptake in employment, in productivity, and consumption. And that's what Sparkle is focused on. Sparkle is focused on helping small businesses focus on their business, and we provide business support services like the taxation, legal services, inventory and invoice management, because we believe that you can't provide that from a human perspective because there are too many of them and you don't have that human capacity. But technology allows you to scale those over-the-counter services. And if you can provide it in a very cost-effective manner, what you will find is more people will pay their taxes because they realize that it is simpler to do, it's cost-effective, they don't need to get a tax consultant. They will access legal services, they will access other types of services that will now create jobs for those types of business. So, and that's where Sparkle is. Sparkle is helping people make things more productive and more cost effective. And we talked about how people are working much harder now in the last few weeks because now they're doing more webinars, they're doing more meetings on Zoom and Teams than they were doing canvassing the whole of Lagos. And that's the exciting. There's so much that Sparkle is going to provide that we believe that we have aligned our model to the new Nigeria, which has to be digital.
Thank you, Zoma. We have a couple of questions from attendees. One of this is that, good day, Zoma. I'd like if you could explain how using unstructured data like social media data and call logs will not breach data privacy laws and regulations, especially in the context of GDPR and Nigeria data privacy regulations.
No, that's absolutely a fantastic question. And you must get permissions. You must get permission. And I think that, like in Sparkle, our values, we have 6 values: freedom, trust, transparency. And those two, trust and transparency, are very, very key. Trust me, you have to trust me with your data. You have to give me information to help you. And it's like the Google, for example, so it's like Google Maps. Google has to get permission, right, to use my GPS, right? And if it doesn't use my GPS, so I can't access Google Maps without giving them my permission. But it is that abuse of permission that we don't want. And so that trust is important. So, and like any financial institution, your business is based on trust. If you violate that trust, people will go away. Now, as people now begin to move into the digital world, trust is going to be a key competitive advantage. You have to be able to display and show that that people would trust you with their data, not money, because now data is a new currency. And so that's very, very important. Yes. Things like GDPR, we must show that we are compliant and not just talking, but actually showing it, and people will know.
This other question is from Emeka, one of the attendees as well. His question is on the credibility and robustness of data in our environment. So sometimes the data from this environment is either not updated or tweaked. Credit bureaus' data are a function of how the financial institutions update the bureau. Even Google Maps also provide data based on the correctness of the mappings done previously. So the question is, how do we manage robustness of data in the environment and its credibility as well?
Another good question, and just like people, another good question, it's like similar to the last question. Organizations are going to have to show that that one, they're compliant in terms of how they manage people's data, how they ensure that the data is correct, and how they take decisions and through that data. And so, typical examinations and audit are going to now put more stress and put more eyes on how making sure that people are collecting data, the data that they're storing, they're allowed to store. There's no abuse or violence of data, because data is now the new gold. And when you put a process around to ensure that the public trust is preserved. Because if we don't do that, and then we must allow for whistleblowing. But if we don't do that, people won't trust technology, won't trust going digital, and that would be bad for the economy at large. So we must make sure that we police ourselves and ensure that we put structures in place to safeguard individuals and their data privacy.
As the final question from the attendees, because we're looking at time, this is from Godson. It says, hello, Zoma, how can we bring in legal aid into our businesses in the case of defaults?
Now, and that's where I talked about, you can't, I mean, like, this is where private sector, government working together to come out with new reforms, look at the existing laws and how we can extend them into the digital to make sure that we safeguard society and we build more confidence. So if we have laws, if we have new laws, and we have reforms, the existing laws that protect people, that facilitate business and reduces the cost of doing business digitally, then you will see a higher adoption. But there has to be collaboration. It cannot be done by the private sector alone. It has to be a combination of government, the lawmaking arms of government and people who protect the regulators.
Thank you very much, Uzoma. We have come to the end of the fireside chat. I have to say it's been a very interesting one. We have so many questions that are still yet to be answered. What I would say to the attendees, these questions will be put together by the organizers and will be shared with Uzoma. And of course, it will be then shared publicly so that you can then get an answer to your questions. Thank you again once, Uzoma, and meet you on the next panel.
Thank you very much. Nice talking to you.
Thank you. Okay, so you are welcome. Good morning, everyone. Again, this is Oluwatobi Boshoro. I'm the moderator for the panel today, and our theme is, navigating risk to capture growth in the consumer credit industry. Today, this panel will be focused on discussing protecting against borrower defaults in a shrinking economy. Okay, so in a short time, I'll be introducing my other panelists. I'll be introducing all the panelists for this panel. Thank you. I can see they're all coming on now. Yes, yes. Okay. So, to discuss protecting against borrower defaults in a shrinking economy, we have a couple of industry players who have experienced the market and understand how to navigate in this times. In the last 8 to 10 weeks, the activities of governments in response to the pandemic, and the requirement of safety and containment of COVID-19 has seen a sudden halt or slowdown to economic activities across the world. Before this, the emergence of COVID-19, we're beginning to see a different robustness around consumer lending. And so this morning, I have a couple of the panelists who will be discussing how we can protect borrowers from defaults at these times. Welcome with me, Mr. Ahmed Bukwola of Credit Registry. Thank you, Mr. Ahmed, you're welcome.
Good morning. I am from CRC Credit Bureau, please, not Credit Registry.
Oh, I apologize. CRC Credit Bureau. Okay, and then also welcome with me, Mr. Tunde, who is from Lydia.
Good morning. Thanks for having me.
Thank you. Welcome with me as well, Mr. Dozier from Sparkle.
Thank you. Good to be on the panel.
Yes, and Mr. Eva Obi, who is the MD of Z-Bands.
Thank you. Thank you for having me.
You're welcome. Thank you for coming on the panel. So the expansion in mobile connectivity and the innovations in big data analytics, combined with new regulatory infrastructure, such as BVN and the credit bureaus, have opened the door to the expansion of consumer lending in Nigeria. Customers previously deemed too risky for credit extension have become bankable customers. The expansion of credit is, however, still in its infancy, with unforeseen risk certain to crop up as the industry expands into new opportunities. The availability of credit is also new to many customers who have no prior experience with easily accessible credit, no credit history, and by extension, have very thin credit profiles. With this background, I'll be asking Mr. Eva Obi of ZVans. With the high likelihood of Nigeria entering a recession by the end of the year and the resultant job losses, how exposed are lenders to defaults and delinquencies by borrowers?
Thank you, Toby. I don't know. I'm trying to turn on my video from here. It's not working. I think the host has to turn it on.
Yes. Brian. Yes, I'm sure that Brian can hear us, and it would help us drive that. Well, please go on. We can hear you.
So okay, I should go on, right?
Yes, we can hear you.
Yeah. It's true. The chances of a recession are indeed high, with everything that has happened with COVID and we could see some of the rating agencies even downgrading some top Nigerian banks, and a lot of people have come up to give all their opinions and ideas as to how much the economy is going to contract by. And it's also going to be determined by what happens with oil prices. As the gluts and countries open up and the demand for oil recovers, but we still expect that oil prices will still hover around $30 per barrel. And we all know Nigeria and how dependent on oil that we are. And when it eventually happens, it's almost looking inevitable that we're going to have that. And when the recession eventually happens, what is going to happen as well that comes with the recession, as we've seen in the past, is we're going to have issues with unemployment. Right now, we've had unemployment trending upwards for so many quarters. And what is going to happen is, people who are already working. Okay, sorry, I'm getting something from. Okay, yeah, you can see me now.
See you now.
Yeah. So what is going to happen is that people who are already working, they're all going to. Some of them are going to lose their jobs, and they're going to join the influx of people who leave school and join the labor market, and without getting any employment because the industries are shrinking, and lenders would be faced with problems on two fronts. Number one is the risk assets you've already created. You have people losing their jobs, and so how are you going to get your money back? And number two is you want to continue doing business with everything that is happening, with the recession that is happening, and you don't know which sector is going to be affected. You don't know who's going to lose his job. Am I going to continue to grow my risk assets portfolio when everything not looking good? So in terms of exposure, very exposed. They're very exposed, and so it's just to look for ways to navigate through whatever happens. I expect that right now risk capital should be lower than usual. This is not the time to be bullish. It's the time for people to assess, if I want to keep growing my loan book, which sectors am I going to focus on? Of course, a recession indeed affects consumer credit industry and even the banks too. We saw what happened in 2016, and people were not able to repay their loans. Yeah, so
thank you very much.
Actually,
yeah, thank you very much, Mr. Eva Obi. The next question goes to Dr. Ahmed Tunde Popola of CRC Credit Bureau. I definitely got it right this time.
Yeah.
On a population-wide basis, what impact would the downturn have on credit scores? Which groups do you think would be the most vulnerable to a deterioration in their credit scores?
Okay, Toby, thank you very much. Good morning, everyone, and thanks to the organizers of this event. Let me start by saying that when we talk about credit scores, we are talking about numerical representation of your trustworthiness and as a borrower based on, consistently meeting payments and not borrowing beyond your limits. So it's just those data that you have in your credit report that are aggregated into figures of 3 digits, basically almost around 300 to 800, depending on which institution. Now, and the things that are really considered in the credit score are basically around 5 elements: payment history, the amount that is owed, the length of credit history, whether you have taken new credit and the inquiries that have been made on you in the last 12 months, and of course, the mix of your credit. So what are the various types of credit you have? But in all of those 5 factors, the 2 that are extremely very important are the payment history and the amount that you owe. Those 2 alone constitutes almost about 60 to 65% of your credit scores. So when you have that kind of situation, then the impact where people are out of jobs, where people are unable to earn their pay, where people are unable to run their businesses, the tendency is that they are unable to service their obligations. And so that will impact the credit scores. So if nothing is done, we are going to see significant deterioration in the credit score of so many people after the pandemic. And the thing to do really is to quickly see how you can address this by, approaching your bankers or those you have borrowed from to restructure your facilities. If you don't do that, the credit score will assume that it's normal, and if you're unable to pay, then there's a problem. I have an incident personally in this during this pandemic. I wanted to pay part of my mortgage loan, and I issued a payment instrument, a check, and I asked it to be deposited, and the bank was closed. I couldn't, and that led to default because I was to pay on the 25th, and I could not pay on that day. I know that significantly will impact my credit score. So that's the kind of thing to watch out for under these circumstances that we find ourselves.
Thank you, Mr. Bukwola. You're quite very right. To Mr. Dozier, what impact would an economic slowdown have on the outlook for the consumer loans industry? Oh, we cannot hear you. Oh, yes, we can hear you now.
Now, it depends. For those that are in businesses that are traditional, for example, let me give an example. And it depends on the type of business. Let's take you have a restaurant that provides that you have to actually come in to eat, to access the services. You're going to have problems because not many people are going out, and of course the social distancing laws prevent how we used to eat before. Now, but if you now have a delivery system, cash flows are still going to come in, and so it means that the access to credit is still available because now you've actually redefined or opened new channels or created new channels in which you can continue doing business. And so for most people, their ability to access finances is going to be hampered in the short term. For those who adopt to the new ways or find new ways in which to provide services for customers or create new opportunities, then these things should be available. So I mean, those who are providing, people who are providing logistics business, for instance, you should see an upturn in business now because people are expecting home deliveries. So if someone is looking for financing to increase their capacity of their logistic platform, then it should be looked at favorably. So there are going to be different instances, there are going to be different opportunities where people access credit growth is going to grow that wouldn't have grown in the past, and there are going to be many areas where, especially as people are laying off people, that you're going to see people whose ability to pay is going to be challenged, and which will require either an extension of the credit or some leniencies while they actually readjust into the new economy.
Thank you very much, Mr. Dozier. Mr. Tunde Kende, the CEO of Lydia, what consumer lending trends are likely over the next 6 to 18 months, say between June 2020 and December 2021?
Yeah, no, it's a great question, and if I wish I had the answer to that question, because then I'd make a lot of money.
I agree.
if that was the case. I mean, so for us at Lydia, we focus on small business lending. So I think we bring a different perspective to this discussion. The one thing that we all have to accept is we're in a very unprecedented time. I think the world hasn't seen this shock to more or less every economy at the same time ever. And it's going to be the biggest shock since the last Great Depression. So I think that's one thing that we have to all accept. And the second thing also is, in this new normal, it's clear that we're entering a marathon, not a sprint, right? So you have to really accept the fact that, look, we're not going to go back to quote unquote normal tomorrow or in a month or in 3 months. And so then trying to understand what does that new normal mean? And also understanding that it won't be, you can't take one brush to paint all industries and all countries. So what I mean by that is, it's clear, as was just mentioned by Mr. Dozier, that look, there'll be these quote unquote essential services that look, because you are needed, whether it's in healthcare, some parts of manufacturing, some parts of logistics, that there'll be increased demand for your services. And the reality is that there'll be a number of other sectors, just given the new normal, where demand will be greatly reduced because we cannot go outside or we cannot frequent particular areas, cinemas, restaurants, etc. You'll be in a big challenge for the next 18 months. And so then, that being said, I think what we're seeing as a lender is we're having to go back and really take a second look at all our algorithms and how we assess to understand a few things. One is, what is really an essential service? And even if you're an essential service, what do we think your new normal will be? Will you have increased demand? Will you have reduced demand? And also layering in the practicalities of your country or your sector. What I mean by that is one thing to be in logistics, but at the same time, if it's not clear, if you can go, travel from state to state, maybe within state deliveries might boom, but we all understand that, look, we also need the ability to connect from one area to another. So with that in mind, I think what we're thinking through is, how do we preserve liquidity, right? So to make sure that, look, you do have enough firepower and dry powder so that you can take advantage of opportunities. And at the same time, I think most people accept that lenders will be cautious until you have a few months of this new normal data to understand, look, which companies are doing well, which sectors are doing well, and then you start to lend from there. So we're approaching it as a marathon, not a sprint. We're taking a few months to really understand what the new level of activity will be. But at the same time, I think it's important for all companies or lenders not to do the reflex action, which is to stay behind closed doors, don't communicate with your customers and hope for the best. I think now more than ever, we have to communicate openly with our customers. We have to aggressively look at the new ways that we assess our different customers and our businesses. And I think you have to invest in R&D. So it shouldn't just be about cutting costs. You have to say, look, if I had to completely look at my business again, how would I design it? And that's going to take talent and technology and new people.
Yes, I totally agree with you, Mr. Kane. So it's about communication. It's about being open, not employing knee-jerk reaction. It's about being, looking at this as a marathon. Totally correct. Because as we see the months unfold, we get to know more about how we manage, particularly as a country, Nigeria, where we have those other macroeconomic issues that impact our economy. Thank you very much, Mr. Kane. To Mr. Dozier, how can lenders mitigate the risk of high defaults in the current scenario? I mean, I'm sure this is a huge problem on the table of every CEO in this market, in the lending market. What are your thoughts?
Well, once the horse have brought it out of the stable and the money is gone. So I think what is needed right now is communication and engagement. You have to be engaging with the customers. You have to actually understand. And I believe that even the regulators are also in contact with service providers as to how they can work together to alleviate the pains of the borrower. And like I had said earlier, there's willingness and ability to pay. Right now, people are there are challenges to pay, but most people, I believe, are willing to pay, and so it means that a loan that had a tenure of a year, we have to start looking at much longer than that. We also have to look at much longer than that, and so that would require a two-way communication. What can you pay? When can you pay? How can you pay? And what can we write off as well? Because some of these things, some of these loans might not be able to be paid off. If you are laid off and you're not generating income, it's unlikely that you'll be able to pay back for a while. So and it's also to start, for lenders, like that, and we can't stop lending as lenders. We have to continue lending. It's also find new markets and new ways to actually lend to people at much lower risk. But for the loans that are already out, it's making sure that you have an infrastructure that allows you to connect with those customers, get more information about how they intend to pay back, what kind of support they need to pay back, and elongating those facilities. That will be my first aid approach to this.
Thank you, Mr. Dozie. So it's about relationship management, knowing your customer, communicating with your customer, and helping them understand how to navigate these times as well. This this is to the to attendees. Please go onto the Q&A button to share your questions, and we would like that you address the question to a particular panelist so that we'll know who would like to respond to your question. So please go to the Q&A button and share your questions. To Mr. Ahmed Popola, what difference would credit bureaus have made in 2009 during the collapse of the margin lending by banks to retail investors on the Nigerian Stock Exchange?
Thank you. Very interesting question, Toby. Let me say that we all know what a credit bureau is. It's a repository for credit data and other strategic information. And the whole essence of a credit bureau is to give opportunity to have insight into borrowers' information, to assist you with the facts that you need. When Uzoma was talking the other time, he talked around the issue of data and hard facts. To also assist you with, processing your transaction on a scientific basis. You have science backing you up now because you now have data, and to enable you to act with confidence. And then finally is to assist you to remove bias and have asset selection in the process of making credit decisions. So if these are things that credit bureau are supposed to do, the 2009 challenge of margin loans happened just the time that the credit bureaus were coming to the market. The 3 licensed credit bureaus in Nigeria were licensed by the central bank in 2009. So things that have been happening in the lending space at that time were what we call lending in the dark. People looking at emotions, institutions not having enough information at their database, now having asymmetric information, just rely on the information that the borrower gives to them. And I think those are the things that really led to the challenge we had at that time. Now, if credit bureaus were to be available then, as we are now, then 4 things will have happened in that regard. The first one is that we'll have presented haphazard selection. And we also have assisted in making sure that serial defaulters do not have access to the loans. Because at that time, a lot of banks did not know where are these people owing, what has their credit history like, and so on and so forth. So they couldn't have prevented that, but that cannot happen today. Then it will have also help them to detect those who already have bad loans. And those are the most significant, people that can negatively impact, the lending space. When you lend to people who already have bad loans and you didn't know that they have bad loans. All of those will never happen today in the Nigeria space. So the lending in the dark era is gone for financial institutions and for all creditors generally who know that the credit bureau have come and they have this repository of data of running into millions of data, which they can leverage on, which they can access anytime, and they can use that to take informed decisions and with level of trust and a high level of confidence.
Thank you, Mr. Popola. One of the trends that I have also noticed is, where customers go to different credit lending institutions within 24 to 48 hours of receiving credit, so that they've gotten credit from institution A before 24 hours when they know that they would have updated the information on the credit bureau portal. They've gone to institution B, institution C, and then they're using about the same credentials to get loans from 3 or 4 institutions within a 5-day period, knowing that they're trying to outsmart the credit bureaus. So we're seeing that yes, there's no more dark edge lending, but the customers are becoming a bit more ingenious in how they try to beat the rules at different lending organizations.
Yeah, so that's very right. You're right, because really, when we started, data is submitted to Bureau on a monthly basis. And so within a space of 30 days, a lot can happen between a borrower and the lending institution. Like you said, if you have a customer who is fraudulent, it will then take advantage of the fact that, well, this data will not be submitted until the end of the month. But the bureaus are addressing all of that as we speak. There's 2 things are happening right now. First one is that the bureaus have the opportunity that you can submit as a lending institution. You can update the data of your customer immediately a loan is granted. And you can do that from your office. You really didn't need to submit. You are empowered. I mean, CRC empowers you to be able to change and update the data immediately. The second thing that we are working on now is to be able to have live connections. So as you are booking the loan, then it's coming directly to the database of the credit bureau. And very soon, this is what is going to happen. This will be the main thing. And nobody will be able to have that opportunity of even 24 hours of a gap in information to cheat the system.
Thank you, Mr. Popola. This is to you, Mr. Tunde Kendi of Lydia. What initiatives should lenders consider to protect their balance sheets from high-risk exposures emanating from consumer lending?
Yeah, I know it's a great question. I mean, for us, so we focus on small businesses. I'll talk about what we do. So our approach has always been centered around 3 main things. So we look very carefully at how we acquire the customer, what's our method of assessment, and how we recollect. So how we acquire customers, in general, we partner with large enterprises. So we have 100 partners now in the country, where from consumer goods companies, payment gateways, banks, where we say, look, we have lots of small businesses who transact with you. Let's exchange data so that we can help them transact more. So either they can buy more goods, or they can process more payments, or they can deposit more money with you. And so we have a set of small businesses who are plugged into great value chains and have been within those value chains for a long period of time. And I think that's what has really helped us a lot around our defaults. So we've now done close to 15 billion naira worth of loans in the last 3 years. And we have a 0.6% default rate, partly because these small businesses are plugged into existing value chains. So I think for us, how we acquire is very important. And I think it's probably a lesson for all other lenders. Around how we assess, I mean, so for us, we are looking at close to 1,000 data points per SME that we assess, and really trying to understand the cash flow ins and outs of that small business in as frequent of a time as possible, so that we're lending to you based on how you perform today. So we're trying to understand, in the last month, how did you grow? And so does that mean that we give you more money or less money? So we're never over-levering you. We find that to be very important. And then around recollection, so we try and make it as automated as possible, so that you're never under pressure to pay a big lump sum at the end of the month, or you forget. And so I say all these things to be general, say that's the framework through which we make sure our defaults stay low. So 1, we acquire a particular type of SME. 2, we assess based on as many data points as possible and as real-time data as possible. And 3, making the recollection process very seamless, while also encouraging you as a good borrower. So constantly sending you credit reports to say, look, you're doing a good job, keep it up. If you pay, you will get a great loan for your next loan, and also a great price. Because one thing we've seen is, typically, not only is there no credit, there's also no consequence of being a good or bad credit. So whether or not I pay on time, I get the same rate as the person who might have paid late. So what we're solving for is, not to punish the good actors because of the bad behavior of the bad actors. So if you are a good actor with Lydia, you'll get a better offer, a better rate all the time.
Thank you very much, Mr. Kende. To Mr. Eva Obi of Z-Bands, is pressure on lenders to offer moratoria, or are they various modification of terms on existing loans as a result of the recent lockdown justified? If so, should there be an industry-wide standard period set by the banking regulator, or lenders should determine their own forbearance? So what's your opinion on the moratoria for looking at the current situation?
Thank you for that question. For me, I don't think you need CBN to tell you what you need to do. What is actually obvious? It's very obvious that the COVID pandemic has hit us, and people have lost their jobs, and people have had their salaries cut. So we should, in everything we're doing, we should open up that window whereby people who obviously their income streams have been strained can come in, and we can always discuss a restructure or amendment of the structure of the loan. For us as Z-Bands, that is what we focus on. We've seen CBN, for instance, come out to say to mandate banks to grant moratoria on CBN-backed loans, on lending facilities that they've given out, and banks have also taken the initiative to say, because they also want to prevent non-performing loans. If your income streams are strained, you can come in to have your loans restructured. But to now come out and say that compulsorily that all lenders must grant moratoria for all their customers, that actually comes from a point of a lack of understanding of how lending actually works. Because this thing that has happened has divided customers into two. One, the group of customers whose income streams are obviously strained that you need to restructure for, and then some customers who, because of what has happened, they don't want to repay their loans. They want to just hold money for whatever eventuality, for fear of anything going to happen. Mm-hmm. So the way I see it is, it's easier for the top players to say, okay, I want to grant moratoria to customers, but what about the fringe players who they need repayment so they can lend more? So when they don't get their repayments, they cannot even grow their risk asset portfolio any longer. They can't grow. Profitability takes a big hit, and also they need to make provision expenses for those loans going bad, and this takes a direct hit on their capital. What we focus in the advance is we try to restructure the ones we can restructure, and then those customers whose income streams are not strained, they still have to pay because it is a contract, and then lenders need their repayments to continue doing business.
Thank you very much, Mr. Obi. To Mr. Tunde Popola, what innovations are credit bureaus rolling out, such as APIs, online decisioning, loan origination engines, and proprietary balance sheet options to help lenders process loan requests with greater clarity on individual borrower risk?
Yeah, thank you, Toby. So we are in an interesting time, and I think a lot of people are spoken to digitalization, which is like the thing that everyone has to embrace now. I mean, financial institutions, we have seen in the last 2 months since April, that those who are able to trade and able to lend are really most of those that have APIs and they have online, connection to their customers. So, and I think that's the way to go. Whoever cannot migrate to that is a challenge. Let me give you an interesting data that we have. In the month of May, almost about 700, 800 institutions, use our platform because it's either through web-based or through live connections. But in the month of April, when we had lockdown, less than 200 institutions, use the database. And the reason is very simple, because a lot of them are web-based. Their staff are at home. They don't have access to go to the office. They could not even engage their customers. So only those who have online applications, those who have mobile, tools are those that were able to lend during that time. And I think that's where the migration is. So, and the bureaus are ready for that. Some of the customers are already on API. They're already on live connection to the credit bureaus, and they're already enjoying that opportunity. And I think it will be very interesting that this is the way to go for a lot of lenders. And the bureaus are really truly ready for that, because some of the customers, some of the financial institutions are already doing that. And so we also then, things that can help lenders at this time are basically still the normal product of credit scores and credit reports. That is still going to be very important for them to review what is going on with their customers and to look at the decision they have to take. Some of them may need to look at the credit score and see whether they can change the parameters of who they borrow, who do they lend to and who they do not lend to at this time. But a more interesting product is the portfolio monitoring report, which the bureaus have also designed to help, lenders monitor the portfolio, the entire portfolio of borrowers that they have. Who are those that have deteriorated? Which products have been impacted much more than other products? Which part of the country, geography-wise, have impacted much more than another part of the country? So all of these have, we have all those tools, encapsulated in what we call portfolio monitoring report. And then, of course, we have, for even consumers, the CLC, for instance, has designed a CLC mobile. From your phone, you can access your credit reports. You don't need a laptop. From your phone, you can just download the app, Google Play, and an Apple Store, and then you check your credit report from time to time, and that gives you opportunity to take immediate action. So those are part of what we are doing. We have batch processing products where banks, financial institutions can do thousands of transactions at a go, and they can take a decision. In fact, there are products now that can tell you yes or no. I just want to know whether a customer is owing or is not owing, or I want to know whether the customer has one single incident of bad loan or no bad loan at all. Just yes or no.
Thank you.
We have all such tools to help.
Thank you very much, Mr. Popola. Thank you. To Mr. Dozier, on the borrower side, how much education is currently available on borrower rights, their privacy percentage of their credit reports, or disputes that arise from their computation?
Okay, I don't have an answer to that, but I can tell you that a lot of work needs to be done, more work needs to be done. And what we're finding, and what we're finding now is that as you come out with new products and services, especially on through digital platforms, it just gives you an opportunity to incorporate education into it, and to make things much more simple. I think one of the things about lending and packaging sometimes from a financial perspective is that there's no common, my own view is that when a borrower comes and you dangle 22, 23, 24%, it doesn't give them a good sense of their ability to pay back. Do I have the ability to pay back from the consumer side? And so that whole, first of all, is standardization of how we communicate to customers. So you borrow 1,000 naira today, that means that you're going to have to pay back 1,200 naira in 6 months' time, which is 5 different payments, and then the interest rate is 21%. I think those are the things that, because you were surprised at how sometimes intuitively we don't understand what 21, 22% means, because if it's per annum or per month, it's completely, those are very complex. So education is a key part, not just in lending, but in terms of what your rights are, and what the implications are if you do not pay back as well. It's always key to know, and also the fact that it is not even the bank's money. So people think, okay, it's the bank money, I'm not going to pay back. It's other borrowers just like you as well. So a lot of education needs to be transmitted from, and also learnings as well, new learnings, because lending physically and lending digitally are two different things as well, because even data privacy laws are very important, are coming to play there as well. So like I said, I don't know how much education is out. I mean, how much people actually know. It's just like, I would argue, people before thought they were banked, but now they feel that they're underbanked, and so that's creating more opportunities for people to provide services. So what we need before, we just need to continue educating people.
Thank you very much, Mr. Dozier. Our final question before we go to the Q&A is to Mr. Eva Obi. What will be the long-term impact of the Black Swan COVID-19 event on risk models by lenders and credit bureaus?
Okay, Thank you, Toby, for that question. It really is a black swan. Nobody saw this coming. And to me, I think the lessons are the impact is going to be from the lessons and then lenders' reaction and efforts to learn from what has happened. First thing I would expect for all lenders to do, that is what we're doing, is for us to revisit our risk framework. We're revisiting our business continuity plans, and we're going to factor in things like this. And it's not just about saying, okay, this is the direction we're going to go if something like this happens again in the future, but also you start preparing your organization to be ready to adopt the policies that you're putting in place. And what I would expect is a lot of us would now tilt towards technology in everything we do, from our risk management and operational setup in all we do. Like, the other speakers or the other panelists have spoken, Mr. Tunde Boland and Ozoma as well. So technology, we're looking at how we're going to digitize everything and try as much as possible to come up with more efficient ways that we're going to use to reach out to our customers. And in focusing on technology, some things are going to happen, which is number one, you're going to see some rules that obviously they're no longer relevant. And so you're going to now start thinking of how am I going to retrain my people, who are the ones I still need and the ones that I still need to make relevant. And apart from that, it's also going to lead to some other risks becoming significant risks like data risk, because data is the fuel that technology needs to work. And you're going to partner with a lot of people, like Mr. Tunde Popola said. Like, for instance, the credit bureaus, you have to partner with them, APIs would connect, and you're going to have a lot of interchange of data. Data is going to keep changing hands. So how do we prevent data leakage? And so, yes. and so on and so forth, data leakage and all the other issues, cyber risk. I can see you want to round up, so no problems. So.
Thank you, Mr. Obi.
Now, I still have to say, but let me cut it off there. It's fine.
No, please go on. Just stay on. We have questions from the Q&A section, and there are a lot of very interesting questions. Let me go very quickly to Mr. Tunde Kehinde. Are you looking at small-scale agricultural processing, and which sectors of the economy are essential sectors to you that you plan to go marathon on? I mean, since you've said you're going to go marathon, which sectors are you planning to go marathon on? And are you, are you looking at small-scale agricultural processing?
So we look at all sectors. We've done loans in consumer goods, agriculture, to agency banking. We look at all sectors. So we're very open. For us, what we look at is risk versus return, and is there enough activity to meet our minimum assessment thresholds, our minimum loan disbursement thresholds, and then can you pay back? And regarding essential sectors, I mean, we have our views, but I think a lot of this will also be informed by policy. What I mean by that is there are some obvious sectors that you think should do well in times like this. So healthcare, logistics, some consumer goods. So for us, we're in particular, I think around the digital services, payments. So we're looking at all those sectors, but I think the policy will also inform, because we also have these sectors that need particular things. They need the ability to transport from state to state. They need funding in terms of, in some cases, FX, etc. So for us, we're very open. We're open for business. We're lending. We're looking to aggressively grow our market share, and we're looking at all sectors.
Okay. Thank you very much, Mr. Kehinde. This question is to Mr. Popola. It's a two-in-one question. The first is that in addition to the live rendition of credit reports, is it possible to specifically provide those details with every search? And how do you engage lenders who do not report credit history of their borrowers as at when due or at all?
Okay, I didn't hear the first part of the question. Can you
the first part says that is it possible to specifically provide the live data of borrowers with every search, and what do you plan to do to borrowers or lenders who do not report the history of borrowers when due or at all?
Oh, okay, all right. So yeah, so it's possible with the tools that we are putting together now, it will be live. And so it will be easy to be able to do that as transactions are happening. But again, like we said, all of this has to do with API. It has to do with connectivity. It has to do with linking up with your tools. So every institution will have things they have to do at their own end to be able to take advantage of this live connection that I talk about. Now, the second part is if we don't have an updated position from an institution, that's very bad. That itself is impacting the institution that refuse to submit the data. Because really, if you have people, you are already subscribed to credit bureau service, and you have borrowers and you didn't submit their information, those things go, they default, nobody will see them, and then you'll not be able to really collect your money from them.
Thank you very much, Mr. Kokola. This question goes to Mr. Dozier. Is there an international initiative to promote youth banking inclusion that can be implemented in Nigeria and Africa? And the other question is, what do you do when a loan is defaulted, a borrower is defaulted, and there's collateral to liquidate? Do you still restructure the loan, or do you advise that the asset be liquidated? 2 in 1.
Like the first question, I think, youth banking is key. The youth are the engine of the future of any nation. So, that awareness is important. But in terms of, but I think every country has its own responsibilities, has its own nuances, and so I think it is up to the different private sectors to define how they want to play in that space. Secondly, if you have a loan that's gone bad and you have collateral, as a financial institution, I don't think most people who do finance loans are in the business of selling collateral. They're in the business of actually lending. And so if there's a workaround, they definitely will try that first before you start selling assets. But that's not what we're in the business for. We're in the business to help people and not to, sell their homes or sell things that they are going to use to generate income and income for their livelihood. So no, unless it is an unwilling borrower, then you now have no choice but to look at offloading the collateral.
Thank you, Mr. Dozier. This question is to Mr. Eva Obi. Please, what happens to your customer that was still servicing a loan in your MFB before it was laid off? Will the interest rate keep increasing? Will you give him some time to get another job, or will you write off the loan?
So thank you for that question. It's an interesting question. In ZVANS, it's something we implemented like 2 years ago or something. There's no penalty for default. So meaning that we try to use it not to compound issues. Someone is owing you, and we've seen these things happen with banks. Someone is owing you, and then let's say the person loses his job. A year later, the person is coming, and then the loan is like maybe ×3 what the customer should be repaying. So interest rate does not increase because it accrues daily, and it doesn't change. And number 2 is what we do is when a customer loses his job and he cannot repay, and he says, okay, I've lost my job. So a conversation happens. And that conversation is for us to know, number 1, are there other sources of income that you would like to keep servicing your loan from? That is number 1. If there is nothing like that, what are your plans to get another job? If the customer is going to get a job in the next 3 months, or say, I'm working on this, I'm going to get this, of course, we give that customer that window to try and secure something else. But eventually, when you're doing business of lending, if a loan that will go bad, that you will not recover, you just need to set a threshold. There are some loans that will go bad that you cannot recover. When it gets to that point, when it's clear that this loan, there is no need wasting recovery or collections efforts on these loans. And of course, we write the loans off and then move on.
Thank you very much, Mr. Eva Obi. I would like to say thank you to every single panelist that has taken time to share their wealth of experience with us on this panel, and to say thank you to all the attendees. I have had a good time. A lot of information has been shared. I have learned very new things. And now, as a practitioner as well as also a borrower, I understand better how to manage my finances and manage myself post COVID. So I would like to say a big thank you to everyone that attended this seminar. Your questions, not all questions were answered on the Q&A. These questions will be collated and shared with organizers, and answers will be shared with everyone accordingly. So thank you and have a good day.
Thank you.
Thank you.
Toby, thank you very much. Panelists, thank you ever so much for that wonderful conversation. Thank you. Thank you
very
all.
much.
Thank you.
Thank you for the opportunity.
It's our pleasure. Thank you so much.
Thank you so much.
Is Shade on now? Yes, I can see you. Thank you. So it is over to you to just begin to prepare us for the next session, which will have some very interesting people as well. So I hand over to you. Thank you so much.
All right, thank you. Thank you everybody for your attention thus far, at least to this final session. And for this panel, this growth opportunities for consumer lending post-COVID-19. And I have some very able speakers, and we hope to make it as interesting as possible. And based on what the previous session, whereby Toby has given us a good background on the significant impact that COVID-19 pandemic has had on global economic activity, Nigeria is not spared. I'm sure we all agree with me. With the fall in oil prices, which has heightened risk perception, both from the sovereign banks to domestic banks, businesses, households, a lot is going on already. And if I would say, there was a recent COVID-19 livelihood tracker that was conducted for the financial sector development programs, which enhancing financial innovation and access is a part of that FINA. So according to this report, we've seen that Nigerian businesses, households are experiencing decreased income. So this has been established based on interviews, one-on-one interviews. People have said, compared to what I was earning this time around April last year, I'm earning way smaller now. So there have been salary cuts, there have been job losses. So this current microeconomic sphere, we've seen that households and even people, lenders in general, we're likely to respond in a variety of ways, from seeking credit help to, how do we rough this patch? How do you think they're going to simulate this? And with all this, we understand that there will be a lot of innovations coming up. We need to review our marketing strategies as lenders. We know that it's not just bleak. It's not like the situation is as bleak as it is, there would always be some silver lining. There will be some growth opportunities for consumer lending. So that is what we want to discuss in this session. So my name is Folashade Agbejule. I'm a program specialist at FINA, and I am on this panel. I have four panelists. So I have Chukwuma Nwanze, who's the Executive Director of Finance and Strategy at Credit Direct. Good day, Chukwuma. Hope you're here. Hi, Chukwuma.
Good afternoon, everyone. Hi, Folashade.
Yeah. Okay, thank you. I'm happy to have you on board. Okay, and I also have Kenewe Matseke, who is the Head of Customer Solutions at Esego Microfinance Bank. Hello, Kenewe.
Good afternoon, Fola. How are you?
Very well, thank you. So I also have Richard Brotoye, who is the Managing Director of Creditville Limited. Hi, Richard. Richard, are you there? Okay.
Yes, I'm here. Hi.
And lastly, All right, thank you, Richard. Good day. And lastly, I'm moving to Jamila Sharif Ayedun. So we have Jamila here. She's representing the Credit Bureau. She's bringing some spice to the discussion with lenders here. Hello, Jamila.
I delivered. Thank you very much, Folashade.
All right. All right. So thank you, everybody. So I think we can delve straight into the discussions. Based on this background that we've given so far, and based on the initial discussions at the first panel, we have been looking at the role of, so for Chukuma now, I'm thinking, what role do you think financial services providers, or even the whole ecosystem, financial services stakeholders, what role do you think the providers especially can help us to play in the economic recovery process after the pandemic is dealt with? Over to you, Chukuma.
Yeah, thanks for Ashadi. An interesting question. I think with or without the pandemic, right, financial institutions will play somewhat similar roles, but in different capacities. So, I mean, I expect deposit taking, giving access to credit, financial advisory, wealth management, and things like that to remain in place. But we are going to see this happen at different scales. In this current season where we find ourselves, and if you listen to the other conversations on the other panel, one reality is that people's earning capacity, whether as a country, Nigeria, whether as corporates or households or individuals, will suffer if it hasn't already started taking a significant hit. And what all that also means somewhat is that there's a liquidity pressure that everyone is going to feel. Businesses or individuals are going to see loss of revenue, which means they are not going to be able to get the cash flows that help them. At the same time, they are seeing escalating costs. The impact of devaluation, rising inflationary pressure is also going to have an impact on them. So financial institutions have an interesting peak in this season to help bridge liquidity gaps, but also advise appropriately on how best, and again, I guess say decide rather sadly on who and whom can access and may not be able in time.
Yes. Hello, Chukuma.
Thank you.
All right. Thank you, Chukuma. So, yes, thank you. So the financial services providers, this is a good time for them to help bridge the liquidity gaps. And you said one expectation is financial advisory, more engagement with customers. Thank you very much for that.
Absolutely.
Okay, so
thank you.
Yeah, thank you. And if we look at, for Kenelwe now, we are looking at results. I know that you are in the deposit-taking lending institution, you're in the microfinance, so you take some deposits. So we are thinking that with this economic shift into some kind of reverse here, if we could put it that way, could the high rate savings account, can we still use this as a deposit growth strategy? Do you think this strategy will come under stress with this economic shift? And what are the results of loyalty and reward programs to draw deposits? Do you think this will still be sustainable and valuable initiatives and strategies to take for this period?
Hi,
Fola.
Hi, Fola. Thank you for that. I hope you can hear me.
Yes, I can.
Well, high interest rates on savings were already under pressure before COVID. They had started to decline significantly, I think. I mean, I can imagine in a post-COVID recession economy, savers are looking for safety nets for their funds. I mean, if I was to sit on the other side of the table as a saver, there are two things really I'll be looking for. I want to be reassured that my funds will be safe. So when I give you my funds today, at the end of the saving term, I will get my funds intact. And if I need my funds for whatever need I need to resolve at any point, I will still have access to those funds. So that for me is very key as a savior. And then of course, we're looking at access. When at the end of the term or when I need my funds, do I need to bring a briefcase to your office to come and collect my savings, or you have available channels for me to be able to move my funds from you to another place or wherever I need. my needs resolved. In terms of loyalty and reward programs as acquisition strategies, I believe at a time like this, saviors are most likely to view such kind of strategies as gimmicks. You know, at a time like this, we need to compete on the strength of our capital. You know, and we need to give our customers comfort that their savings would be safe during this time. But just in wrapping up, I still think interest rate will continue to be under pressure, and the key messaging and the key, what customers would really be looking for would be the safety of their funds.
Yeah. That says a lot. That tells a lot. So there was even, this strategy was already under stress even pre-COVID-19. So we still need, there's still a need to review at least going forward. All right, thanks for that, Penelwe. So Richard, I'm looking at the previous discussion, the previous panel. We've looked at the moratorium. We've looked at consensus on late repayments and even defaults in this period. So different voices, different people or analysts are voicing opinion that lenders, rather than just jumping to late claim on consumer assets and just classifying them as these are in default, rather that we should need to partner with customers to help them walk through these financial challenges. So I'm wondering, do you share this view, or does your institution share this view? And how feasible, this second option of partnering with customers to help them walk through financial challenges, how feasible do you think this will be? Because looking at, like, for example, your institution, we've been doing a lot of online lending, we've not done a lot of face-to-face interactions. Now, this strategy would require us to have very high-touch interactions with these customers. So what strains do you think this will place on your online lending operation model? Thank you, Richard. Over to you. Hello, Richard.
Who are being, yeah, I can hear you. Like I said, now more than ever, automation is key in the lending space. So for institutions who have fully automated or who are partly automated, it will be much easier for them to handle crisis during this COVID era. So your question concerning how an institution should treat customers who are having difficulty in meeting their obligations at this point. One of the panelists said before now that institutions like us are not in business taking over customers' assets. We are in the business of lending. So since the inevitable has happened at this point, I mean, there's no point pretending about it. The inevitable has happened, and a lot of customers are unwilling to pay, even when they willingly want to pay. So the best thing to do first for an institution is to, first of all, look into the data. Classify your customers into different buckets. Who are the customers who, before the COVID era, payment history? For those kind of customers, you should be able to batch them, treat them.
Hello, Richard.
Oh, have been, can you hear me?
Okay, we can hear you now, you're back.
Okay, so if a customer walks into Credit Bureau today and wants to renegotiate a loan facility, the first thing we look at is what's the customer repayment history. If the customer has been having a good repayment history, it will be so much easier to do a restructuring for the customer, because this is a COVID-induced default. So it's almost automatic that you would do a restructuring for the customer. Now, for customers who've had bad repayment history all along, the treatment of such a customer will be different from the customer who has had a good repayment history before now. So it's not a given that every customer will get a restructuring automatically. A lot depends on what kind or what quality of asset the lender had with the customer pre-COVID. that will determine the kind of restructuring or the kind of acceptance, such a customer would have, with the lending institution. So generally, lenders will be willing to restructure for customers, but like I said, it depends on the customer history. And institutions right now, I'm sure a lot of institutions right now are looking through their data and having what we call here a preemptive restructuring policy for customers. So what we are doing is we are already looking into our data and we are preparing for an influx of applications from customers. Now, we have given mandates to the people in charge to say, this set of customers, when they come for restructuring, we've given them the power to go ahead and restructure for those customers. And for another set of customers, we will definitely refer them to recovery because their kind of default is not induced by COVID. So it's a two-way thing, okay, that will be induced by customer repayment history. Now, your second question, could you please repeat your second question?
So I was talking about how feasible do you think this one-on-one customer engagement and interactions will be? Since while we're discussing the loans, we leverage a lot on online lending. Do you think this interface, do we need to review some of this online operating models? I think you've answered that, yeah. Yes, Richard.
Going forward, I think going forward, a whole lot of us lenders would have to bring in more technology into our engagement with customers. So in the last few weeks, there's been a lot of, requests coming in, people who want to speak with customer service, customers who want to be, who want to make submission as to the performance of their facilities. Now, if you acquire 10,000 customers via mobile app, it would be difficult for you to resolve their issues if you have an influx, say 100 or 200% increase, into customer service. Okay, it will almost be impossible for you to address all of them the way you onboarded them. So I think going forward, what a whole lot of us are doing are trying to put in place chat bots. Okay, that is ongoing right now in the whole of the lending institution. It's going to take time, but before we get there, we would have to continue using low touch method to engage customers. But I can assure you, in the next maybe 1 or 2 months, a lot of lending companies would have onboarded a good platform to help us engage customers so that we can attend to as many customers as possible, because either we like it or not, this request will come in and we have to be able to attend to all of them.
Good. Thank you. So this shows that even the online lending operating model has come to stay, and it can only come to stay even post COVID-19. And you want to leverage a lot of customer classification to help you handle this. Thanks for that rich answer. And now, Jamila. So this is, with our passion for financial inclusion, I know that Jamila shared that passion for finance, especially for those who were previously outside the formal financial services space. And we are looking at what impacts this economic downturn could have on the role of consumer lenders, the roles they've been playing in financial inclusion by helping these individuals to build up their credit profiles. Many of these customers, especially the micro lenders, many of them actually into the formal lending system. They're even coming into the formal financial services space for the first time. So what kind of impact do you think all these issues will have? Jamila, over to you.
Thank you very much, Folashade, and good afternoon, everyone. I think that question in particular, given the severe economic impact today in Nigeria, and actually it's happening globally, lenders across the country are facing some serious impacts due to the difficulty in their customers being able to pay. Unfortunately, many people just are not able to pay because either their income has been removed or their revenues have been reduced. Yes, we know that. And in addition to that, the cost of doing business has even gone up. And so this is almost like a double whammy when it comes to trying to do business. And if you think about the last part of this is the fact that they're also dealing with some form of, even now, emotional strain. You have people also having to deal with medical issues of their families. So all these things have a serious, impact. And I believe that it is so important for us to now understand that these are not issues that were on personally. This is something that was unforeseen by everyone. And so I would certainly not advise that we have such things, harsh repercussions on loans at this point and causing, penalties and fees as a result of people not being able to pay. That would all, to me, just honestly, just accelerate this economic downturn. So there's some things that I would certainly recommend for lenders, support of government, of course, to do to be able to relieve borrowers at this time. There's three things in particular. I believe communication, compassion, and creativity are absolutely required. So when it comes to communication, just keep in touch with the customers. This can be done remotely, it can be done digitally, but it demonstrates to them that we actually, as lenders, that you actually understand the challenges that they're going through, and that you actually are aware and know that this is not going to last forever. And so as a result of that, borrowers will be able to know that you still are expecting their payment. You are still their bank. You are not ignoring what's going on, but you are expecting still for them to pay. And I think that that's important from a communication perspective. Compassion, I believe that we, as lenders, they need to proactively offer options. Don't wait for a customer to come to them. We know what's going on in the industry. We have the data to demonstrate if there's some challenges as a result of this. So proactively offer options. You can do payment deferrals to avoid write-offs. You can do refinancing, restructuring to reduce the minimum payment amount. And even some type of payment freeze or moratorium. This will remove any accruing interest during those periods of time where people are not able to pay. And I'm going to tell you personally, I went into my own banking portals where I do have loans, and I didn't automatically, I saw that my interest rate had been, interest payments had been frozen. I only have a principal amount that needs to pay. This actually encouraged me to say, do I have any extra funds? Because I can now pay off my loans because no interest is incurring on them. So those are the kinds of things from a compassion perspective that might be able to serve borrowers. And the last one I believe that is most important is creativity. Lenders, I believe, honestly, need to take this opportunity to support the borrowers with things such as, because they're right now looking for new ideas. They're doing more with less. The industry is ready to reopen, regroup, rethink, reimagine, rebuild, and do everything. And this is the time where they're gonna need the funds to be able to do that, right? I also believe that it's probably going against the conventional comments here, but I think it's time for the banks to be open. I believe it's time for them to still mitigate their risk very, very carefully. But there are things out there to support them. There's technology. We have, from a bureau perspective, we have credit scores, we do pre-qualification, we do monitoring of portfolios, even risk-based pricing solutions that are available. This allows for the banks to still be able to scale during a difficult time. And I also want to just acknowledge in closing that we do have credit registry. We're very fortunate to have some loyal customers who have been with us for over 17 years. And I want to use this platform as an opportunity to even challenge them. I would like for them to take up a call to action. This is a time whereby there are customers in their portfolios that actually have loans in multiple places. And at this time, it's so challenging to have to try to service all these loans different times, to be able to pay them different interest rates. If you have a good customer, consider some form of loan consolidation. Help your customers to be able to have potentially one payment at a lower interest rate and be able to cover the cost or pay off their other loans. And then you will be able to now have a customer that I would say consider a loyal customer. And there's one quote from Warren Buffett that says that someone sitting in the shade today is because someone planned and planted a seed long ago. So by doing this now, these are the customers that you will build your business on in the future. So I believe that this is a time to look at that.
Yes. Thank you very much, Jamila. So you're telling us and all the stakeholders and especially the providers, the lenders here, that creativity is very important at this period to support the borrowers and able to support the system. So I agree with you that a one-size approach fits all. One-size-fits-all approach will definitely not work now. So we need to evaluate different styles and we need to be creative and innovative in our approach. Thank you for that. So Kenewe, I'm looking at let me say maybe for your bank, for your microfinance bank like Tego or any other one, are we likely, this topic, actually, this session, it talks about marketing strategies and growth opportunities for consumer lending post-COVID-19. So we're looking at, do you think we will see some shrink or expansion of advertising and marketing budgets in the short term as we resume? Or, and even that, to what extent had your, earlier in previous years, pre-COVID-19, your marketing and ad budgets, how much was the budget driven by reliance on data and analytics, probably in the past 3 years? And what do you think is likely to change in the next 12 months? Thank
you, Fola. A shrinking marketing budget, maybe not. A slightly increased marketing budget, maybe we can be looking at it for now. I mean, a well-oiled marketing machine is critical in this post-COVID era as there's a need to get the right narrative out there and push awareness and new initiatives and changes that will emerge post-COVID. Sensitization, I mean, look, forgive me for using this very popular used phrase, the new normal, business space, social distancing rules, remote working rules, new safety rules. All these will require, I think, a very robust marketing budget to get the right message across, because you're going to have to now start using different mediums that you probably never used to use before, so you can try and drive this message home a bit more. I would say our marketing initiatives and budget are to a certain extent driven by data. As we analyze our current customers in terms of age, gender, location, we're then able to use social media tools to send targeted messages to potential customers using the same demography. So, I mean, I guess from a brand awareness standpoint, you would want to probably maybe send messages across all segments to push word of mouth, because how you sell your products really is not about your potential customers, about everybody else also helping you sell by word of mouth. In the next 12 months, as more people are probably going to be online, and we're probably going to see our marketing strategy change a bit from what we've been doing to more social media marketing, sort of. So we'll also see our marketing budgets change towards online digital marketing.
There will definitely be, so the marketing budget is definitely not going to decrease. So we would more on we're acquiring different models and methods of marketing. So that is interesting. Thank you for that. So we were considering for Jamila, this concept of quick loan, at least in the past pre-COVID-19, with the emerging online lending schemes and ability to evaluate credits, online. Do you think the whole concept of quick loans, no hassle loans, do you think there will be a review even for those in paid employment, not to even talk about the ones that are self-employed? And because of this increasing default rates, what level of impact on credit histories and profiles do you anticipate? Jamila.
Yes, thank you. I mean, I think that in particular, it's an interesting question because globally, lenders are having to, I'm going to say, even cut off credit limits and things like that because the cost or the interest is just incurring when people are not able to pay off loans. And in general, the quick, no hassle loans, they are high interest rate loans. They're short-term loans. Even in a great economy, is very risky and is very expensive for the consumer. So not to even imagine in a strained economy where we are right now, these loans can, I think, be very detrimental to the financial system if we're rapidly giving out these very high interest, no hassle loans. So people who certainly take these loans, they have a need for them. And I even attended one of the Athena presentations not too long ago, and it expressed that over 50% of the people who had been surveyed were missing one or more meals a day as a result of just not having enough income. And so if we're going to continue to do these quick, no hassle loans in an economy like right now, that money will be used, to me, I believe, on things such as just everyday survival. And it's not really going to be used towards, I'm going to say, profitable endeavors, right? Which is meant and designed to be able to pay off those kinds of loans. So I would beg to differ and say that in this time and effort, lending is still absolutely required. The market is going to need that, but it needs to be more of a patient type of lending. It needs to be longer term. It needs to be at better and more affordable interest rates to allow people and businesses to be able to manage today while also still planning for that growth in the future, especially in Nigeria. People are so entrepreneurial, incredibly profitable when they're doing their businesses. So we just need to have that type of patient funding. So in order to encourage lenders to do this, even what's happening globally, what lenders are focused on is compliance. They are reporting their loans to the bureaus routinely. They are not missing a beat. I think it was mentioned earlier, I always say that there should be no hiding place. Any loan that is being given at the point it is being given, you can upload that to the bureau because your customers are free agents, they can go anywhere. Secondly, monitor those borrowers, probably more than before, because times are changing so fast for people. Today, you know, they're working, tomorrow they're not working. And that's very, impacts alone. So monitor those customers, make sure that you are looking at various ways. With our services, you can market, mine, manage, and mitigate. So it depends on what you're looking for. If you're looking to market and grow, loan consolidation, all those kinds of things, you have the tools available to do that. And then lastly, I believe pre-screening is incredibly important. So picking and choosing your customers, if I can be more blunt. So pre-screening, finding good pre-qualified customers. They are out there, they need services, and finding the good customers or likely good customers are a great way for the banks to be able to meet up during this time. I want to end with just one thing, Fola, Sade, if you don't mind. During this time at my office, it's closed, it's locked down, but we do have essential staff that have been signed that are working. I'm one of those essential staff. So I have taken on some of the additional responsibilities, such as monitoring customer support lines and things like that. So our WhatsApp line got hit up by a consumer. They wanted to order their credit report. I gave them the process to go about doing that. They got it in a matter of a few minutes. And then they contacted us back and said that he had some outstanding loans that he needed to clear off. And he had been declined for credit, and that's why he was reaching out to us. He wanted help. He wanted to understand, why he's attempting to get credit and he couldn't. He had an outstanding loan obligation of 400,000 naira. He says he doesn't want to miss his payments. He had been laid off from his job. And clearly he just wanted to be able to not have any type of emotional stress at this point, but how could he get help? So he was looking to get a new loan to pay off an existing loan that he had been previously paying off religiously. And so we advised him that instead of trying to go get a new loan, talk to your lender. Explain to them the same thing that you explained to us. Now, he didn't know this was me or anything. He's just talking to customer support. So he explained to the lender, we advise him that he can get different types of, ask for different types of help, whether it's a payment freeze, whether it's, some form of restructuring or something. And so he came back to us a month later or so. He said that he had contacted his account officer They had essentially been able to help him restructure his loan. They additionally gave him some form of relief on his payments, and he paid off the principal, leaving only the interest payments to now pay off. And so this goes to show you that in a market like where we are now with even COVID-19, there are people who are willing to pay, but are just not able to pay. And if they don't know that these programs exist, they're not doing any help to the bank that has given them those funds, nor any help to themselves, because it's being reported negatively against them in the Bureau. So he was able to address that, and we were able to even help him pay off his interest payments. So now he's 100% loan-free, able to rebuild his credit. And he just said, thanks for the confidence for being able to help him to do that. So those are the things I want to extend out there.
Yeah, thank you, Jamila. This shows that even the crisis, you know, many people with the crisis, people are, especially the borrowers, they are concerned about their credit history. Beautiful credit profiles and histories they've built so far with the credit bureau. They don't want that tarnished, they don't want it affected, which is a very good insight from you, Jamila. Thank you. Thank you for that. So if I'll quickly have this short discussion with Richard on the innovations, you know, for this segment, we're supposed to look at some opportunities, some market opportunities that are coming up out of COVID-19 pandemic, of which definitely we know that some other innovations will come up among lenders. So do you think this borrower repayment turbulence could precipitate some new innovation in terms of untapped opportunities? And, you know, of course, before this time, and in recent times, we saw that there's been some shift to automated response platforms, which Richard, you mentioned earlier that many of the online lenders are working towards that. So, but do you think there would still be an aggressive development of this, or we go back to our person-to-person engagements? Like, let's not even go too far now. Let's just go back to our person-to-person engagement. Do you think this is going to work? Do you see the industry going back to that space, or even the commercial banks probably coming back to claw back on the market share, which you emerging online lenders were taking before? Hi, Richard.
I think the trend we are going to see going forward will be more of data analysis in the medium term for organizations who have not started making data their priority. We are going to see an increase in involvement of analytics experts. We are going to move into the era of machine learning, okay? Because this era that we are in right now, the COVID era, a lot of things that were not happening before are going to happen. A lot of industries that were classified as low risk are going to become high risk. A lot of job functions, a lot of organizations are going to be reclassified around this time. So we are going to have to learn more from what is happening right now. And for companies who are automated or who are automating, we are going to have to probably tear down our scorecard and rebuild from scratch if the correlation we are seeing is not positive. Now, where we have a positive correlation with what we had in our scorecard and what is happening right now, maybe little adjustments. But going forward, what we are going to experience is one, a lowering in credit limits, a stricter scorecard system. We are going to have, in the medium term, shorter loan tenors built into the system, such that the automated lending system will become more utilized. However, lenders have to ensure that they automate even further than we had ever automated. Because machine learning will do what ordinary human minds, cannot do at this time. So the further we automate our loan onboarding process, the better we become at learning, the repayment culture, at learning different things about, the entire end-to-end system. So I don't see us benefiting from any reversal of the automation, going back to manual, low touch. That will still exist because technology is expensive, and only organizations that are able to afford such technology, to employ data analysts and machine learning experts, that will be able to afford this new technology. We'll still see low touch, where you can walk in, apply for a loan, and maybe 3, 4, 5 days get a response. But mainstream lending now will become more digitalized, more technology driven. Mainstream lending will become more high touch, more high tech, okay? Because sophistication tends to bring more scalability, okay? Scalability, and that is what the lending space requires right now, to be able to reach more right customers quicker, when they need it, okay? So technology is the way forward. High touch is the way forward. I don't see more space for low touch and human to human interaction in the lending space. It will still exist, but it will become more and more obsolete. And looking at what COVID has even brought, social distancing, more and more customers would want to sit in their office and apply for loans rather than risk having to walk into a lending institution to talk to people who they don't personally know. Okay, so that in itself induces us to use more high touch to engage customers and to onboard customers.
All right, Richard, thanks for that detailed explanation. We expect more high touch now. The person-to-person engagement is not, as in leveraging heavily on person-to-person engagement like we used to, is not so likely. Okay, so if we look at, so let me just go to my last question, which is with Chukuma. Chukuma, are you there?
Yes, I am.
Okay. Yes, so I'm looking at the competitive landscape. You've been in this industry for a while, so you have an understanding of this. How do you think the competitive landscape has evolved in this past 5 years? And do you see a recession and significant borrower defaults? Do you think this will lead to a shakeup among consumer lenders? For instance, could some lenders start exploring consolidation and the like? What's your take on that, and what's your experience so far?
Okay, in the last 5 years, I mean, I've seen the industry characterized with new entrants. There's been significant investment in technology. I think Richard has done a brilliant job detailing how technology is shaping the lending industry. There has been significantly higher defaults. I mean, because with new entrants comes an avalanche of choices for customers. So 10, 15 years ago, outside banks, maybe there was one or two traditional lenders, but today you have a couple of them out there. So customers now have access to multiple credit sources, and we've seen that competition for spaces in customers' hearts even lead lenders, okay, to somewhat over leverage customers these days. So you're going to see in the industry, the average borrower is borrowing from 2, 3, 4 financial institutions. So like I was saying, we've seen higher default rates, and NPL margins have been on the rise because disposable income is not growing at the same rate as the needs. They have been escalating prices. I think we've suffered a second devaluation in the last 4 years. We're about to enter a second recession in the last 4 years. So disposable income is not rising at the same rate as those escalating costs. And so that gap is widening, and the way people have chosen to bridge that gap is by borrowing more. And as they borrow more, it's leading to higher default rates. And even for lenders, the industry is now characterized by thinner margins, of course, because loan loss provisions are on the right, because asset quality is taking a battering of some sort. The industry has certainly changed from what it was about a decade ago, right? That said, what lenders do is critical for an economy, especially a developing economy like ours, to thrive. And I think a recession will be announced probably at the beginning of Q4, but we begin to feel the impact of it already, considering that there's a double whammy, the impact of COVID-19 and the resultant effect of the oil price crashes that we've experienced in the last 3-4 months. So lending organizations in themselves are at different spectrums, if I'm allowed to say, on the survival timeline. I believe that right now most organizations are in survival mode, while growth can be moderated, but survival is big on everyone's mind. Let's bear in mind that we haven't truly felt the impact of COVID-19 or the economic circumstance we find ourselves in. So it's extreme early days. I think in the next 3 to 6 months, we are going to start feeling that impact more. I mean, we were in lockdown for the past few weeks, so we only started getting out again. And so people are meeting higher prices. And so even organizations can't reliably estimate the damage this pandemic and the economic situation will have on their businesses. Now, different organizations with different balance sheets, with different asset quality in their portfolio, with different cost profiles, are all situated somewhat in this industry. If we're not going to be swept away by those with the huge balance sheets, remember, I like to see the lending spectrum in some boxes or in some buckets. Let's think of the commercial bank or deposit money banks, who in the last few years have become very active in giving consumer credits. Let's look at what I'll call structured traditional lenders. I mean, the big ones who are spread across, they're not necessarily MFBs. Let's look at microfinance banks. Let's look at the fintechs, because in the last 5 years, we've seen the emergence of wholly digital type lenders. And let's not forget the unstructured lenders, because even though they are fragmented and not known, they play a very pivotal role in the way the whole industry itself is structured. It will be interesting to see how players in these different touch points along the industry path can consolidate. Could it be a consideration? I think it might be. Would it be an easy thing to do? I think it's going to be extremely difficult. Remember that let me call it the consumer credit industry in itself is relatively new. If we remove it from exactly what the traditional banks have done over time, what businesses like Credit Direct, who led the way in unsecured lending, have done, is create a new industry, and that industry in itself is just about 15 years. So we have different organizations with different characteristics, with different levels of transparency, with different levels of and skill sets and competencies, really, in true sense of it, and different philosophies, right? So it's going to be an interesting one if you're going to be able to see organizations that can share the same values, share the same ideals, or have the right pricing points that would lead to a consolidation. But I dare say that if very many lenders are going to survive the next few years, it's not something that shouldn't be considered. How that would happen will depend as time goes on.
That's interesting. That's interesting. So we should watch out for the unstructured and the informal lenders, because even right now I see some fintechs trying to digitize that space already and harmonize this structure. So it will be interesting to see this evolution. So thank you very much, panelists. Let me just take 1 or 2 questions as we are running out of time. I see that some participants have been dropping questions in the chat box. And I think I can quickly direct this to Richard. Please, a minute or 2. This person wants to know, for the lending space, what could be the disadvantage of going fully digital, considering the age bracket of customers and the portfolio of consumer lending companies? Briefly, what are the risks that you foresee in going fully digital, Richard? You're muted, Richard.
I think age in analysis, lending analysis, is just one of several hundreds or thousands of data points. So I don't see how age will have a significant impact. It's more to do with repayment history, current loan exposure, income. Those are the things that really seriously impact the data points in the scorecard. So I don't think it will play so much of a role. Okay, the age bracket, I don't think it's going to play so much of a role. But if you talk generally, what are the risks going, fully digital? The relative risk you face in technology, IT risk, data risk, modeling risk, those are the kind of risks that you would come across when you are fully digital. And these risks are, I would say, edged by your lower defaults. Okay, so where you have this risk, the benefits of going fully digital is that you acquire a culture of machine learning, data analysis. You're able to learn your customers more accurately. Okay, so the more digital you go, the more accurate your analyses are. So these is like a give and take. They outweigh each other. However, the weight of or the advantages of becoming more digital outweighs whatever risks that that comes with it. These risks are risks that you can easily take. You can easily mitigate against. You can easily take. Correct. As you go along, as as the technology gets better. So I think it's still much better to go digital.
Okay, thank you. Let me just take one last question and this will be for Jamila. Please take just a minute. I know you have this at the top of your fingers. So what are the checks put in place to ensure that financial institutions upload all customer data and also upload accurate data? How do you ensure, what are the checks you put to ensure accuracy? And how do you identify the red flags in the credit history that your customers are uploading? Briefly. Thank you, Jamila.
Okay, yes, thank you. So I was just to encourage one thing. If you are a lender in Nigeria and you are giving money to customers, it is absolutely free on credit registry to upload your loans to the Bureau. It is a ticking time bomb if you are giving loans and you are not uploading that data to a National Credit Bureau. We have hundreds of institutions, nearly 10,000 users who are using that information every day. The likes of LetsGo, CreditVille, Credit Direct, all of them are using that information to make the best informed decision. So if you are lending in the dark, that is not good. The technology that allows you to do that, it can be done anytime. It can be done literally real time if you so desire. You can upload it through an FTP. You can send it through our desktop application. We give you every means to be able to do that. And there's an immediate validation that takes place once that information gets uploaded to our bureau. We validate, are you meeting the right metrics or the information that is being sent, because there is a common data template that's out there. We're also looking at things such as, does the information even make sense? Are you saying that the loan was started a year ago and then the amount that was due 2 years ago? So the mismatches are taken care of. We look at things such as the BVNs. Do you have good quality BVNs? We have discovery services to help you find and get the right BVNs for your customers. So there's so many things that you can do as a lender to protect your business and to minimize your risk. The one simple, easy, no-cost thing to do is to share your information to the Bureau, so that way your risk exposure is known before other lenders give credit to your customers.
Thank you so much, Jamila, and to all the panelists and participants. So let me hand over to Mr. Frank Agbogun to close the session. That has been very interesting. Thank you.
Thank you so much, Folashade. Yes, thank you.
Thank you, Fola.
Thank you very much.
Mr. Frank, you're muted.
Thank you all so very much. Whether you are in the business of consumer lending, or you are a small business or an individual struggling with an existing lending or credit, Or maybe you are one thinking of how you can leverage consumer financing to get away from the difficulties we're in and emerge from it stronger. I have absolutely no doubt that you have benefited a lot from the conversation. I took a lot of notes as I listened to you all and analyzed the idea of being proactive, especially on the part of the lenders, as one of the panelists said. You know, the tree that provides a shade today was a seed that was sown, Jamila said, and I found that very tough. There is also the question that was raised about loan consolidation, which is not practiced so commonly here, but is something that we see working very well in other countries. And it has to be that after this challenge or in the midst of this challenge, that the way we engage with customers, the way the customers themselves, you know, prepare themselves to ensure that they have better consumer profile. I have absolutely know that all of that will change. Let me once again thank you all so very much, including the panelists in the first session, and of course, Josie also had a one-on-one with Toby. You have been great panelists and great moderators. My thanks also to our sponsors, without whom we would not have been able to do this today. There is no question, the insight that you have provided, the knowledge that you have shared will be of immense value to our audience. But as I say, everything good comes to an end. And so we would like to bring this conversation to a close and to hope for our audience, about 200, 300 who have been able to join us. I hope this has been an exciting and interesting time for you. Keep safe, and let's see at the other side of this. Thank you all so very much. Thank you.
Bye. Thank you.
Bye.
Thank you.
Bye. Thank you so much.
Thank you.
Thank you. Thank you.